In many consumer marketplaces, firms operate under simple transaction rules. A customer pays money, a firm delivers a product or service, revenue appears immediately on the firm's dashboard, customer dissatisfaction appears later, if it appears at all. The rule is simple. Revenue is recorded the moment a transaction clears. Operational strain appears weeks later in support queues and complaint logs. The financial report updates every day. The trust signal moves slowly across months of customer behavior. Immediate reward, delayed cost. Inside the firm, revenue dashboards refresh every morning. Teams review daily transaction totals during short internal reporting meetings. Managers compare current revenue to weekly extraction targets. Those numbers determine bonus calculations and quarterly performance reviews. A product manager faces a small operational decision: remove a minor fee or keep the fee active. Removing the fee reduces daily revenue numbers immediately. Keeping the fee preserves revenue visible on the dashboard. Customer dissatisfaction might rise later, but that signal does not appear in today's report. The micro decision becomes straightforward. The fee remains, the transaction completes. Revenue appears instantly in the accounting system. No operational alarm triggers at that moment. No customer leaves immediately after a single small loss. The incentive becomes visible. Immediate financial confirmation. Across the company, similar decisions occur inside multiple teams. Each product team optimizes its own short-term extraction point. Fees accumulate quietly across different parts of the marketplace. Subscription renewals become harder to cancel. Pricing steps become less transparent inside checkout flows. Each change produces a small increase in recorded revenue. Each change remains below the threshold of immediate customer exit. Local success, short-term numbers improve. The finance department sees steady revenue growth in the reporting dashboard. Quarterly presentations highlight increased transaction efficiency. Performance reviews reward teams maintaining extraction stability. This becomes the first locking moment. The system begins to follow the metric. Revenue growth becomes the dominant performance indicator. Operational capacity reports remain secondary during internal review cycles. Support teams notice a different trend inside their own dashboards. Customer complaints slowly begin to accumulate. Backlogs expand inside support ticket systems. Resolution times extend across multiple weeks. Escalation queues begin forming between support and product teams. But the revenue dashboard continues to rise. Extraction remains profitable. A coordination breakdown begins between two groups. Product teams monitor revenue performance indicators. Support teams monitor complaint volume and refund requests. The two dashboards show conflicting realities. Product sees growth, support sees strain. Support teams request adjustments to extraction features. They present ticket backlog statistics during internal meetings, but those numbers appear in a different reporting channel. The financial dashboard still dominates executive review cycles. The system keeps following revenue. Another measurable distortion begins to appear. Reported performance improves. Operational capacity deteriorates. Customer support staffing remains constant. Complaint volume grows across multiple product features. The system absorbs the pressure temporarily. Backlogs grow quietly. Refund requests increase month after month. Support resolution times double compared to the previous quarter. Yet revenue dashboards continue reporting stable extraction gains. The distortion widens. Revenue signal up. Operational capacity down. Individual firms continue making the same rational micro-decision. Keep extraction features active while revenue remains strong. Remove them only if immediate losses appear. Immediate losses rarely appear. Costs remain delayed. Across the broader marketplace, multiple firms adopt similar extraction strategies. Each firm captures small additional revenue from individual transactions. Each firm assumes customers will tolerate minor losses. Customers initially remain inside the system. Switching costs remain inconvenient, but trust begins shifting across repeated interactions. Customers start expecting hidden charges and delayed refunds. They read transaction details more carefully before confirming purchases. Transaction friction slowly increases. Trust declines. Firms respond by increasing extraction intensity to maintain revenue growth. Checkout steps become more complex. Subscription renewals become harder to detect before billing cycles. Extraction continues producing local financial success, but the marketplace changes structurally. Customers begin entering transactions expecting possible financial loss. New firms entering the market adopt the same extraction playbook. Transparent pricing becomes less competitive against short-term revenue strategies. The system converges toward a new equilibrium. Individual firms remain profitable in the short term. Revenue dashboards continue validating extraction strategies. But trust across the marketplace erodes. Customers approach every transaction defensively. Local success persists. System failure spreads quietly. As extraction strategies persist, internal hiring criteria begin shifting quietly. Recruiting descriptions start emphasizing revenue optimization experience. Product analyst roles require familiarity with pricing leverage experiments. Candidates present case studies showing successful fee optimization strategies. Interview panels review dashboards showing short-term revenue improvements. Those examples become signals of operational competence. A hiring document circulates inside the product division. It lists revenue conversion improvements as preferred portfolio evidence. Customer retention metrics appear further down the evaluation sheet. The system begins selecting for extraction fluency. Revenue first. Internal training sessions begin referencing successful revenue adjustments. Slide decks show examples of minor fee additions increasing daily transaction yield. Teams review those cases during quarterly internal learning meetings. The examples enter internal playbooks used for new product launches. Playbooks standardize the approach. Step 1 recommends identifying small monetization gaps inside checkout flows. Step 2 recommends testing microfees that remain below cancellation thresholds. Step 3 advises monitoring daily revenue dashboards for immediate confirmation. Customer complaint monitoring appears in a later section. The logic becomes operational routine. Inside operations dashboards, 2 reporting cycles run at different speeds. Revenue dashboards update hourly through automated transaction systems. Customer complaint summaries update weekly after support ticket consolidation. The time horizon mismatch becomes structural. Fast reward signals dominate decision cycles. Slow cost signals arrive after multiple reporting intervals. Extraction expands gradually across more transaction points. Scaling begins amplifying the pattern. As transaction volume grows, each small extraction feature multiplies revenue impact. A single fee applied across thousands of transactions produces measurable gains. Operational strain also multiplies across support ticket systems, but the signals appear on different dashboards. Information remains fragmented. Product teams continue reviewing revenue dashboards during daily meetings. Support teams review ticket backlog reports during weekly operational reviews. Those reports rarely appear in the same room simultaneously. The coordination gap widens. Another distortion emerges in operational capacity reports. Customer support headcount grows slowly compared to transaction volume. Support dashboards show increasing queue depth across multiple service categories. Yet revenue growth continues validating current extraction structures. Operational strain becomes background noise. Inside product documentation systems, extraction strategies become templates. New feature proposals reference earlier monetization experiments. Design documents include sections labeled revenue leverage opportunities. Those sections appear before customer friction analysis. The sequence matters. Teams replicate the structure across product updates. Scaling amplification continues expanding the pattern. A small pricing adjustment in one marketplace segment appears successful. The change is copied across additional categories in later release cycles. Each copy increases daily revenue metrics on internal dashboards. Revenue momentum builds. Operational strain grows quietly underneath. Support escalation logs begin recording repeated refund requests. Agents track refund categories through internal ticket tagging systems. The backlog expands during peak transaction periods. Yet refunds remain individually small compared to transaction totals. The revenue report still dominates executive reviews. Another mechanism begins reinforcing the pattern. Information asymmetry spreads across the system. Firms see immediate revenue signals inside their financial dashboards. Customers see only individual transaction outcomes across separate purchases. Each customer experiences small losses independently. No single transaction reveals the full extraction pattern. Losses remain distributed. A cross-sector feedback loop begins forming. Customers grow cautious during marketplace transactions. Checkout review time increases as customers inspect pricing details. Firms interpret slower conversion as a signal to adjust monetization structures. Extraction mechanisms expand to compensate for reduced transaction confidence. Revenue pressure returns. Scaling continues multiplying the effects. The number of active transactions increases each quarter. Each extraction point now touches larger customer populations. Support teams begin logging delays across refund processing pipelines. Queue length grows. At one internal review meeting, a comparison briefly appears. Revenue growth charts sit beside support backlog graphs. For a moment, the numbers appear connected, but the relationship remains uncertain. The reports return to separate review channels. Revenue dashboards resume dominating the next meeting cycle. Operational strain continues accumulating in support infrastructure. Oversight capacity struggles to scale with transaction growth. Audit teams review financial performance reports quarterly. Customer complaint data arrives through slower aggregation channels. By the time patterns appear, extraction structures are already widespread. Oversight lags behind operational change. The system keeps moving forward. Cost redistribution further hides structural decay. Refunds distribute losses across different accounting periods. Individual compensation payments appear minor in quarterly summaries. Support staffing absorbs the immediate operational burden. Those costs disperse across multiple departments. Revenue concentration remains visible. Short-term extraction remains locally successful. Hiring pipelines continue selecting revenue-focused analysts. Internal playbooks continue recommending monetization leverage strategies. Operational dashboards continue prioritizing immediate financial signals. Each layer reinforces the same structure. The marketplace adapts around the pattern. Across the marketplace, the same pattern now repeats automatically. Firms review revenue dashboards each morning. Customers review transaction details each purchase. Support teams review ticket backlogs each week. 3 dashboards, 3 timelines. Revenue signals remain immediate. Customer costs remain fragmented. Operational strain remains delayed. Extraction continues appearing profitable inside firm-level reports. Local success remains visible. But across the marketplace, transaction behavior slowly changes. Customers begin approaching each purchase expecting hidden extraction points. They pause longer before confirming transactions. They search for alternative sellers across competing listings. Conversion slows across multiple categories. Firms respond the same way the incentive structure rewards. They increase extraction intensity to maintain revenue targets. More fees appear, more friction appears. Support queues grow. Refund pipelines expand across operational systems. Internal staffing discussions begin referencing support backlog thresholds. Yet the revenue dashboard still defines performance reviews. The incentive signal remains unchanged. Immediate gain, delayed cost. So the same micro decision continues repeating inside product teams. Keep the extraction feature active across thousands of transactions, across hundreds of firms. No single firm created the outcome intentionally, but the marketplace structure gradually reorganizes around extraction logic. Customers expect hidden charges before every purchase. Firms expect revenue increases from each additional fee layer. Support systems expect rising complaint volumes as routine load. The system stabilizes around this pattern. Local profit continues appearing rational. System-wide trust continues eroding slowly beneath it. The equilibrium persists because the rule never changed. Immediate revenue remained rewarded. Delayed trust remained invisible. So the behavior followed the signal, and the system adapted around it.